Hi everyone, welcome to my channel InfoCraze. Today we will discuss some common questions that may be asked in a job interview for the position of financial analyst. This video will be very useful for students and professionals for going through the answers to these crucial questions. Before proceeding further, let me request you to subscribe to my channel if not done yet so that you do not miss out my future videos. So let's get started. The first question we are going to take up here is, how do you interpret a company's balance sheet and income statement? Balance sheet and income statement both are the key financial statements used to assess the financial health and performance of a business, but they serve different purposes and provide different types of information. Balance sheet provides a snapshot of a company's financial position at a specific point in time, usually at the end of a fiscal quarter or year, showing its assets, liabilities, and shareholders' equity. Assets are what the company owns. Liabilities are what the company owes to others, and shareholders' equity represent the owner's stake in a company. Thus, assets are the resources owned by a company, whereas liabilities and shareholders' equity represent the sources of capital for the company. This information derived from the balance sheet helps a financial analyst to assess a company's ability to pay for its short-term operating needs, meet the future debt obligations, and capacity to make distributions to the owners. Relation between these three fundamental elements of a balance sheet are described in the accounting equation, which states that sum of all assets is equal to the sum of liabilities and shareholders' equity. The income statement shows the company's revenues, expenses, and profitability over a specific period, indicating the ability to generate profits. Revenues are the income generated from the company's primary activities. Expenses are the costs incurred to generate those revenues, and profitability refers to the ability of a business to generate profit from its operations. Now, let's look at the question number 2. What is a cash flow statement? Why is it important for financial analysis? A cash flow statement is a financial statement that provides an overview of the cash inflows and cash outflows of a business over a specific period. By analyzing the cash flow statement, one can understand how a company generates and utilizes cash, assess its ability to meet its financial obligations, and evaluate its overall liquidity and financial flexibility. It represents the cash generated by a company from three different types of activities. First is operating activities. This section includes cash transactions related to the core business operations of the company, such as cash received from customers, payments to suppliers, and operating expenses like salaries and utilities. Second one is the investing activities. Here, the cash flows associated with the investments in long-term assets are recorded. This includes purchases or sale of property, equipment, investment in other companies, and other long-term assets. Third is the financing activities. This section covers cash flows related to the company's financing activities, such as issuing or repurchasing of stocks, borrowing or repaying loans, and payment of dividends to shareholders. Net cash flow provides insight into the liquidity and financial health of a business by showing the net amount of cash generated or used during a period. It is calculated by summing up all the cash inflows and subtracting all cash outflows from the three main categories of activities: operating, investing, and financing. Question 3. Can you explain the concept of discounted cash flow analysis? Discounted cash flow, that is DCF analysis, is a valuation method used to estimate the present value of an investment based on its expected future cash flows. It involves discounting the projected future cash flows back to their present value using a discount rate, typically the company's cost of capital, which is the rate of interest used to calculate the present value. Some of these discounted cash flows is considered the fair value of the investment. If the present value is positive, after deducting all expenses and taxes, then the project is said to be viable. Otherwise, the project is considered to be financially unviable. Thus, DCF analysis estimates the value of return generated from an investment after adjusting for the time value of money, which assumes that money is worth more today than it would be in the future. For example, the worth of $100 today would be lesser in future due to interest and inflation rates. Question 4. What is working capital management and why is it important? Working capital refers to the difference between a company's current assets and its current liabilities. Thus, working capital is equal to current assets minus current liabilities. It represents the amount of capital available to a company for its day-to-day operations. Thus, working capital management involves the management of a company's current assets and current liabilities efficiently to ensure smooth operations with maximization of profits. It represents the set of activities performed by a company to ensure having enough resources for its day-to-day operating expenses in the best possible manner. It's important because it affects a company's liquidity and ability to meet short-term obligations. Second is, efficient working capital management can improve cash flow and profitability. It helps in minimizing the cost of capital by optimizing the use of resources. Question 5. What do you mean by liquidity in finance? How is it different from solvency? Liquidity and solvency represent different aspects of a company's financial health and stability. Liquidity refers to the ability of a company to meet its short-term financial obligations with its short-term assets. It focuses on the availability of cash or assets that can be quickly converted into cash to cover immediate liabilities. Common liquidity ratios include the current ratio and the quick ratio. Maintaining adequate liquidity is crucial for a company to operate smoothly, as it ensures that it can pay its bills, meet payroll expenses, and cover other short-term expenses as and when they arise. Liquidity is different from solvency. Solvency refers to the long-term financial viability of a company and its ability to meet its long-term financial obligations. Solvency focuses on the overall financial health of a company, particularly its ability to generate enough income to cover its long-term debts and sustain operations over the long term. Common solvency ratios include the debt-to-equity ratio and interest coverage ratio. You may refer to my video on accounting ratios to get more insights on these ratios. With this, we come to the end of this video. If you find this video useful, please like the same and share it with your friends. You can also watch my other videos on accounting ratios and financial management. Further, please subscribe to my channel for many such interesting videos. If you have any question, please put your query in the comment section. Thanks for watching.